Lights, camera. Meet the pros who shape the industry and see what it takes to join them. Beyond the Frame, only at Orange Technical College East Campus.
Thank you for coming today, and today is going to be a learning experience. We're here with Mr. Nathan Gogger, who is the founder and the managing partner of Blue Heron, which is a company specialized in tax. I will let him tell you more about it, but what I want to point out before I give him the mic is going to be interaction. So it's like you are in the classroom, the teacher is talking, and then you can ask questions anytime you want. Okay, let's make it fun and let's not be stressed about it, and let's be open to learn more.
Awesome. So as he said, my name's Nathan Gogger. I'm with Blue Heron CPAs. Today we're going to talk through W-2s, 1099s, and moving towards how estimated taxes work. I know not a lot of people in here have probably experienced estimated taxes. You may realize that as a business owner, that might be part of the criteria that you will live with for the rest of your life if you do own a business. But it's a very important aspect that we see a lot of mistakes in all of these areas. And we're really hoping that through this education, I can help people not make those mistakes. Obviously, to start with every single financial presentation that you will ever see in your life, typically starts with a disclaimer. Keep in mind, I am not your accountant. I am providing this advice as a very generalized advice and should not be construed towards being specific to you and yourself. So please go talk to somebody, and you will see that theme pretty consistently through this, that I want you to talk to somebody about your specific situation if you're dealing with an issue, if you're encountering something that's problematic. There's a lot of issues that happen in finance world. Getting someone that's on your side that understands it's a very important aspect. Today we're going to really walk through, once again, W-2 versus 1099 contractor. What does that actually mean? We're going to talk about how the IRS looks at worker classification. And there's actually been some changes within the past couple of years that theoretically would affect a lot of people, but not a lot of business owners realize that this has happened. Some compliance requirements and pitfalls, and then finally, once again, the estimated taxes. Awesome. So W-2 versus 1099. I imagine that a decent amount of people here have jobs already. Who here has a W-2 job? Who here is an employee? Awesome. Is anybody running their own business? Yep, we got one. Awesome. So as a W-2 employee, you are hired for an ongoing role. You are going to be someone that is being paid by another individual, typically on an hourly basis, and the employer really controls what is done and how it is done. So it's more of you're running their processes, their procedures. You're under their guidance. You're using their technology. You're getting paid directly by them, usually on a periodic basis that's biweekly or bi-monthly. You're paid via payroll, which also means that your taxes are going to be withheld by the employer. And there's going to be a stark difference here between the employer and the W-2 versus just being a 1099 and a contractor. And then once again, you would receive that payment, and there would be benefits that are offered by that employer as well. So whenever you have that employer-employee relationship, look at your employer and see what benefits are actually offered. They might offer an HSA, a 401k. There's a significant amount of benefits that are available to you. As a contractor, all of that oversight kind of gets taken from you. It's not a bad thing. It maybe call it opportunity. But the most important thing that you have to understand here as a contractor is you're on your own. Your employer, the person paying you, is no longer going to withhold your taxes. You are now responsible for your own taxes. You're going to invoice for your services typically. It can be on a periodic basis. It can be on a project basis. But you're typically going to be hired, and the payments are going to come in as a lump sum. No taxes taken out. You are 100% responsible for those in the vast majority of situations. And you're going to receive what's called a 1099 at the end of the year. A 1099 non-employment compensation, 1099 NEC for short. Those are in this current year going to be $600. For those that paid you more than $600, next year it's going to be $2,000. That's an update with the new tax bill. You are typically ineligible for the employee benefits that the employer would typically offer. You now need to create your own benefits. So if you need a 401k and HSA, that's you're going to have to create those typically on your own. So any questions there? Does that make sense? Contractor, you are on your own. Employee, you have someone that's helping you with the tax side, with the actual getting paid side. Awesome. So is anybody here, are you aware that it's not a choice whether you're a W-2 or a 1099? It's not a choice. So a lot of people will say, oh, I'm going to go get a 1099 job or a W-2 job. The actual delineation between whether you're a W-2 or a 1099 is based on how the person that's paying you actually controls the situation. So if they have heavy control, if they're the ones providing the infrastructure for you to do the work, if you follow their processes and procedures, you're going to typically be a W-2. If you're kind of on your own, you're working out of your own house, you work on your own time, maybe you're paid by project rather than by hours that you work, then you're typically going to be more of a 1099 worker. So if you have that employer that's paying you on an hourly basis and you're doing everything for them and they're 1099ing you, you shouldn't be a 1099. You shouldn't be a contractor. You should be an employee. And it's very important to understand that, because there are laws and there are protections that you have as an employee that you don't have as a contractor. You should really try to get in front of this and understand whether as you get a job, you should be a W-2 or you should be a 1099, because it's kind of on you to understand that. And once again, if someone is 1099ing you, but they're treating you like an employee, you're 100% liable for your own taxes, right? That's something that's added responsibility that you have. So understanding whether you should be a W-2 or a 1099 and then getting that correct as you're actually working, bringing up that up with your employer from the start, not in the middle, from the start. Hey, I should be a W-2. Extremely important here. Awesome. Any questions about that, by the way?
One quick question. What do you mean by we don't have a choice? Isn't it true that some companies, they give you the option to be either an employee or a contractor? Or is it like, let's say I don't want to pay tax, I want to pay my tax at the end of the tax year. Can I make a choice, like personally, okay, I said, I don't want to be an employee because being an employee doesn't give you overtime, or being an employee doesn't give you that much time to travel. Can I make this call?
So you're 100% correct that a lot of companies will give you that choice. In the process of them giving you that choice, you should be really seeking for the duties to be altered as well. If you're an employee, they should treat you in a certain way. You should be tracking your own time. As a contractor, it should be on a project basis. A 1099 versus a W-2 job should not look the same. If I go get a construction job that's W-2, it should look very different from a construction job that's a 1099. If I go and this is digital production, right? A lot of these are digital production people. If you're going and shooting a scene for someone and it's one scene, it's for 8 hours and they just need you for those 8 hours and they offer you $200, $300, well, great. That's probably not an employee relationship. That's a specific contract. You're doing that once. If you're working for them over and over again, it looks to be permanent, that this is what you're going to do for the rest of your life, it's a lot less likely that that's a contract job. So to your question, yes, if you have the choice, yes, a lot of employers will give you that choice. It doesn't mean that those jobs should be the same, though. They should look very different.
So which one, in terms of advantage, which one you think as a prospective employee, which one you think have more advantage in being a W-2 employee or a 1099 contractor? Which one will give me more money and help me pay less in tax?
That's a great question. So let's get on to where the taxes actually come in, because I think that this is a great segue. Okay. So as a W-2, I don't know if any of you have received a paycheck recently, but that $15 or $20 an hour times the 40 hours that you worked, that's not what you receive, right? It's less money than that. It hurts whenever you see how much money they take out. Mm-hmm. So part of this is called FICA. FICA is going to be your Social Security and Medicare, and Social Security is going to be withheld from your paycheck at 6.2%. Medicare is going to be withheld at 1.45%. So whatever you have as your gross pay, the total that you earned, that 20 hours, $20 times that 40 hours, that $800, they're going to take out 7.65% of that immediately. You're also going to have withholding. That withholding is going to be a much more difficult conversation, much more difficult percentage, but that is going to be the estimated taxes that you're paying as an employee. They're going to take that out as well. So typically on an $800 paycheck, you'll see anywhere between $740 all the way down to $600 is what they're typically going to be remitting to you on your paycheck. Once again, as an employee, they're taking out 7.65%. Very important number. We'll come back to that in a few seconds. You are also covered by labor and employment laws. And then you are going to fill out at the very start a W-4. There's a very confusing form that you will fill out whenever you're on your very first day. If you fill that out properly, they are going to withhold taxes based on that W-4. If you want to withhold more taxes, step 4C allows you to put, hey, take more money out of my bank account or out of my paycheck. So that's the process. You provide a W-4, and that's how they withhold taxes on you. They will always withhold that 7.65%. So those are the key features of being a W-2 employee. As a 1099, do you remember that 7.65%? We're going to double that. Painful, right? If they were already taking out 7.65, now they're taking out 15.3, but they're not taking it out for you. Your duty is to pay this at the end of the year. So 15.3% of whatever your net income is going to be taxed, and it's going to be self-employment tax. So huge, 7.65 times 2, that's going to be 12.4 Social Security and 2.9 on Medicare that you're going to have to pay at the end of the year on your net income. That's not going to be revenue though. So your revenue minus your expenses equals your net income. So whatever you profited throughout the entire year is what's going to be taxed through what we consider self-employment tax, and that's going to be the 15.3. You're going to be able to set your own schedule as a contractor, as we discussed. You should be paid typically on a project or on a results basis, not on an hourly basis. There are contractors that are paid on an hourly basis. Most of them we see performing certain duties. And then you're also responsible as a contractor for your own benefits and your own insurance. So if you are working and you are providing services and you do not have insurance, there is a legal liability that is a lot higher whenever you're performing work as a contractor. So in theory, if I'm going to get taxed more and I need to pay expenses as a contractor, I should be getting paid more, right? So if someone says, I'm going to offer you a $20 an hour W-2 job or a $20 an hour contract position, hopefully this helps guide you and you're getting more money as a W-2. You're getting more protections. Those are extremely important. As a contractor, you are legally obligated, as you receive payment, you have to provide them a W-9. W-9 is a very simple form to fill out for those that don't have an EIN, an employee identification number. You're going to be able to submit this W-9, and that's what they will file the 1099 against you. So it'll be the employer providing you the 1099. As an employer, if you're in a W-2 relationship, the employer provides you the W-2. So that's how you're typically going to file your taxes. So how should you take a employee or should you be a contractor? I don't have that answer. If someone offers me $30 an hour contract or $20 an hour W-2, I still don't have that answer. It depends what I need to purchase. It still depends on what I need to actually buy in the process of providing the contract. So there's not a great answer.
No, it is.
But there is tax implications to it.
Okay.
So once again, just kind of reiterating, as a W-2 employee, you'll provide a W-4 to your employer. That's how they will withhold taxes. And you're provided a W-2 at the end of the year. As a 1099, you're going to submit a W-9. And that's going to provide them the ability to give you back a 1099 NEC. As a contractor, I'm going to say this over and over again until I'm blue in the face because I see the issues all the time. They should have really no control over your day-to-day methods whenever you're a contractor. You should be able to provide the work on your own schedule. Obviously, if it's a contract for showing up for one day, they're probably going to have a little bit more control. But if you're doing it permanently, think of like an advertising agency versus someone showing up and providing day labor. The advertising agency is going to have control over their entire situation. Any questions there? We all good? Okay. I just see mistakes in this all the time, and it's going to lead me to my next thing.
Okay, I have a question quickly. I've seen people filing W-4, and then they're married, they say they're not married. They have kids, and they say they don't have kids. What would make them do that?
So filing the W-4, if you file the W-4 as if you're single, it will withhold as if you are on a single tax bracket. So married filing, there's different tax brackets for whether you're married, head of household, married filing separately, or single. So is everybody aware of that? If you're a single individual, you get taxed differently than if you're married. I think that that's pretty common knowledge. Whenever you fill out the W-4, if you are single and you check that you're married, they're going to withhold less money from you, meaning your paycheck's going to be larger. But at the end of the year, you pay more taxes. You get hit with a large tax bill. My entire goal here is that taxes should not be a surprise. If you get hit with $3,000-$4,000 owed on your tax bill, which is very common, unfortunately, that shouldn't be a surprise to you. You should know that you need to pay it. By filling out that W-4 accurately, you can make it so that you don't get that surprise tax bill at the end. But as you put more deductions, as you identify more credits, as you withhold less money, more money is going to be owed at the end of the year. If you withhold more money, if you're married and you identify it as single, which you shouldn't, but that is what a lot of people end up doing. If you identify it as single, they're going to withhold more money from you. In your tax return at the very end of the year, 415, that 1040 that you file, is just a reconciliation of all of the income that you earned through the previous year, along with all of the money that you paid in throughout the entire year. That's all a tax return is. It's just the story of what you did financially in your own life. So it's very important that if you set the W-4 up properly, it'll withhold properly, and you'll make the most proper decision where hopefully you don't owe and you don't get a refund at the end of the year. If you get a refund, that means you paid in too much. If you owe money, that means you did not pay in enough. It's as simple as that. So what happens if you are misclassified? Someone's paying you as a contractor and you should have been a W-2 at the end. And maybe let's switch this. Maybe you're the employer. If you're the employer and you want to pay people as a contractor, but they should actually be a W-2, you have a situation called misclassification. Misclassification, the results of those, the employer or the person that's paying the individual could actually have to pay back all of the taxes that they should have paid. So let's say someone did that for a couple of years and you go submit to the IRS that you were misclassified. You as the contractor might be able to get all of that money that you're supposedly paying in taxes, where you may not have most of that due, which is, it's kind of crazy. In a lot of construction jobs, we see this. Someone's paid $80,000, $90,000 a year for all of their construction work. They were misclassified. They submit to the IRS that they were misclassified, and the employer has to repay $40,000, $50,000 in what is now back taxes. So this classification issue is very common, very important. Please don't be misclassified. Understand it on the front end. So does that make sense? If you misclassify someone or you are misclassified, you should go and talk to somebody. Keep in mind, if you are a contractor and you are working and you are misclassified, if you go and report that to the IRS, if you go and that employer is probably not going to be too happy with you. You're costing them potentially hundreds of thousands of dollars. So you really need to think through what's happening as you're going through that misclassification process. But go talk to somebody. If you believe that you are misclassified, understand what your rights are as a United States taxpayer. And then don't misclassify people yourself. I know it's a pain to get payroll set up if you're a business owner. I don't know if you have employees, but it's a very large pain and it becomes very expensive. So yeah, just be very careful with that. Okay. This is a very simple cost comparison between the two. Once again, if you are a W-2 employee, the employee is going to pay that 7.65. Employer is going to pay the 7.65, adds up to the 15.3 that you would pay as a 1099. Those are big differences. So I've kind of set this up for the next section, which is estimated taxes. Is anybody wanting to be a contractor, wanting to be a business owner in the future? Yeah. So we add a lot more than currently are in business. So this is the reason why I see most businesses fail, is that they don't understand how estimated taxes work. Once again, you don't have that friend that's on your side that's paying your taxes for you through payroll, right? You're now responsible for all of it on your own. So there's two ways to avoid penalties with this. And maybe this isn't the best way to start. Maybe I should go to the next slide and come back. Estimated taxes. The idea here is that I need to have all of my taxes paid in 4 equal increments throughout the year based on what my income is going to be at the very end of the year. So let me walk that back for 1 second. On April 15th, the expectation from the IRS is that I know what I'm going to make on December 31 of this year. How many of you know exactly what you're going to make right now, whether you're W-2 or not? You don't know what you're going to make. Creates a really large issue, right? So if you don't know what you're going to make, you kind of have to guess. If you're going to make more, in theory, you need to withhold more. Those withholdings are going to happen in 4 equal increments. If you look at Q1, Q1 is going to be April 15th, so the same day that your taxes are due for the previous year, they're going to be due for the current year. 1/4 is going to be due for the current year. June 15th is this Q2, September 15th, and then January 15th. Please don't ask me why it's 4.5, 2 months, 3 months, 4 months. I didn't make the rules. But yeah, it's not even. It's not on an actual quarterly basis. You're going to be making these 4 payments. So whatever your total tax liability is based on all of the income that you earned, you divide that by 4. And that's going to be due in 4 equal increments. Does that make sense?
Yes.
Awesome. The expectation is that you know what you're going to owe on 4/15 of the next year immediately on 4/15 of the previous year. That's not typically how we work. So there's 2 ways in which you can handle this as a business owner. One, you should be understanding if you're making more money, you're probably going to owe more taxes. That's pretty straightforward, right? If you're making less money, maybe you owe less taxes. So there are 2 ways to avoid this. You can look at your current year. Hey, I'm planning on I owe $20,000 in taxes. As long as I have made payments of $18,000, which is 90% of the current year's total tax, that is what's called a safe harbor. They will not penalize you for that. Whatever is left due is still going to be owed on 4/15, but you need to have made those estimated tax payments. So the total tax divided by 4 of the current year, you need to have paid at least 90% of that in the current year. Once again, we don't know what our income is. Things happen, things change. Sometimes you make a lot of money in December, sometimes you don't. And if you don't know that, then you don't really know how to adjust for 90% of the current year. So we have another safe harbor. We have last year. We can look at last year, and so long as I pay 100% of what I paid in taxes last year, which I know people view their refund as if it's a refund or whether they owe money at the end of the year, that's whether it's a win or a loss on taxes, right? It's really not the way that you should be looking at it. Line 24 of your tax return is where that should really be at. And if you look at line 24 and you divide that by 4, you should pay that amount, which would be 100% of your prior year's total tax. You should be paying that in for estimated payments. So I'm not going to get penalized so long as I do one or the other. I pay 100%, or if I'm over 150,000 AGI, 110% of last year's total tax, which is line 24 of your 1040, your personal tax return, or I need to have paid in 90% of my current year's total tax. Those are your two choices. Otherwise, you get penalized for it. I'm not going to go through how Form 2210 calculates things. It's a very complex form to really go through, but that is the form if you want to read the directions on how that penalty actually gets assessed. And there is a way, if you do have uneven income, to kind of mitigate some of those situations. But for the most part, following these two, the two safe harbors, the 90% of current year or 100% of last year's total tax, is going to really help you out. So, any questions there? No? Okay. There's a couple of ways to pay. The IRS is no longer accepting checks, which is really hitting the elderly extremely hard right now. You probably have grandparents or parents that are paying estimated taxes and yeah, they have to now do it online. So you can do it through direct pay, which is through the IRS website, or you can do it through EFTPS, which if anybody knows what that is, I think you're probably the only one that knows EFTPS. As an individual, you probably don't want to know EFTPS. It's not a user-friendly site. So the IRS online account, please do not make payments through third parties that aren't the IRS. There's a lot of scams, a lot of things happening. Being that you can't just mail a check anymore, I cannot tell you how many people have lost thousands of dollars paying it to the wrong entity. Set calendar reminders. If you do have a bookkeeper, they should be sending you that information. And then whenever you do make that payment, print off the confirmation and send it to your tax preparer, because you're going to need that at the end of the year. Awesome. And I am getting towards the end here. As far as the IRS itself, we in Florida, we have federal taxes. Everybody's aware that we pay federal taxes here in Florida. Are you aware that there are also state income taxes? Okay, yeah. So that's a very common misconception that I see. There are state income taxes, and I want you to be very careful whenever you're working as a contractor. As an employee, your taxes are based on where you work from. It is always sourced where you work from. If you travel to New York and work out of New York as an employee, your taxes will be due to New York. Even if you permanently live here, if you traveled up there and did work up there, you would need to pay employment taxes to New York. As a contractor, that is very different. Yeah, you got a question? If you work out of country, that is a very complex question. Depends on if you have a treaty. So international tax law is probably, you could literally learn one country, understand it, and make a fortune as an accountant. It depends on the country. It depends on some of the treaties that we have with those. That would determine what your tax liability would be. So I don't have a great answer for that. If you are a business working, though, from out of state, you definitely have United States source income. So just keep that in mind, is even if you're in a different country working for a United States company, and this is kind of where I was going with it. Let's say you're working in Florida and I'm providing services for the state of California. I'm always here. I never go to California. I never touch California dirt. But I'm working for a business that's in California remotely as a contractor. I might owe California tax. Are you guys seeing the pitfall here? Okay, so everybody's very used to employment law, which is you pay taxes where you work. Whenever you turn into a contractor, that can completely change. Gets into very hairy decisions. Um, Talk to somebody before you go through that. So Florida does not have individual income tax, but businesses do have some state tax obligations. There is a Department of Revenue here. There is sales tax obligations. There is employment tax obligations. So please don't think I live in Florida, we don't pay taxes, because that's what people say. It's not necessarily always true. So I'm just trying to make sure you guys don't hit those same pitfalls that I see so often, because they become painful whenever they add up for 5, 10 years. Awesome. So action checklist. We need to provide the right forms. If you're providing a W-4, what are you? You're W-2. Okay, so if they have you sign a W-4 at the very start, you're a W-2. Really look for that as you start a new job. If they have you sign a W-9, what are you? You're a contractor. They're going to send you a 1099 at the end of the year. You now understand your tax obligations for each of those. If you're a 1099, you have your own business now. Congratulations. If you're a W-2, you're treated as an employee. You have additional rights. You have additional things that are happening behind the scenes. They're there to help you. They're there not to hurt you. They're there to set you up for success. It is much more difficult to be a business than it is an employee. So just very much keep that in mind.
One quick question.
Yeah.
Does that mean if you have a 1099, you have to have a LLC, or you have to be a business owner, or can you just have a 1099 without owning a business?
It's a great question. Okay, so if you are doing anything with the intent to profit, if I make bracelets and I have the intent to profit and I sell those bracelets, you have a business. That means that you have a job, you have a business if you have the intent to profit. If you don't have the intent to profit, but you're still making money, you have a hobby. And I'm sorry that is so broad, but if there is the intent to profit at any point within what you're doing, there is a business activity that is happening. It's very important to understand that. A lot of people, they're like, oh, I just do this little side hustle, and maybe you go to box breaks, I think, are the most common thing that I see. I don't know if any of you know what box breaks are, but people go online and they buy a whole set of Yu-Gi-Oh cards or something like that, and then they sell one pack at a time, and they make $50 off of a box or whatever it be. They had the intent to profit because they were splitting up that merchandise and selling it individually with the intent to make a little bit of extra money. They created their own business. So they have things that they have to do. They have filing obligations that they have to comply to. There's a lot more compliance there. So does that answer your question?
Yes. But what about, let's say I am, back in the days when we had the traveling nurse, for instance, and then they go work for different companies, different states, and then they're not like a regular employee. They have a 1099. So are they required to register the business?
Yeah, so and this gets kind of towards the legal. I speak primarily towards the tax side of it. Typically, whenever you're traveling to another state, you really need to look at their own laws, but you may need to register potentially as a foreign LLC if you have an LLC. You don't necessarily have to have an LLC to operate as a company or a business. It's strictly the intent to profit. An LLC is actually not even in the Internal Revenue Code. If you look at it, there is no, I'm taxed as an LLC. I guess that's a common question that I get is I ask, how are you taxed? And they say, oh, as an LLC. As an LLC, you're either a sole proprietor, a partnership, an S Corp, or a C Corporation. You can be taxed as any of those as an LLC. Most people start a business using an LLC formation for legal purposes. It does not necessarily change your tax purposes. So there's a difference between organizing and incorporating. I'm not going to get into the density of that, but you don't need an LLC to have a business. You can just perform work as yourself and you still have a business so long as you intended to profit.
Okay.
You have any questions?
I do. I think, are all 1099s taxable?
All 1099s, so 1099s are business income.
Okay.
So if I'm claiming income, I may or may not be taxed on income if I have more expenses
Then,
than the income that I received.
and then they only tax the income, the 15.3, correct?
The net income, correct. Your revenue is not taxed. So a 1099 would identify the revenue. So you have 1099 NECs, 1099 MISCs, you have 1099Rs whenever you become retired or you withdraw out of retirement accounts. You have 1099Ks if you're using a payment processor such as PayPal or eBay. They'll send you a 1099K. That is your revenue. Your revenue minus your expenses equals your net income. And your net income is typically what you are taxed on.
On that same token, is there a certain amount to have to declare your tax? Let's say I'm receiving a 1099 in which I make $250 for the whole year. Do I still have to declare that? Do I still have to file my tax?
So $1 is typically the threshold for tax filing as a business. There are other thresholds as a W-2. So if you made any money as a business, there's a technical definition that you have to file your tax return. I'm sure that we could get in 100 arguments over, should you actually file your tax return? But the requirement is that if you have self-employed income, you do have to file, even if it's just $1, which is it's an unfortunate standard, but it is the reality. Yes.
Guys, it's your time to ask questions.
I have one more. What is the dollar amount for Social Security till it becomes taxable?
Dollar amount of Social Security is $1. So Social
anytime
Security
you
is
get-
always going to be
Tax.
taxed.
Gotcha.
So on all of your income, you're going to have 6.2% if you're an employee. Even if it's $1 of income, they're going to withhold 6 cents out of that. And then your Medicare is going to be a portion of it as well. There is a point where Social Security is no longer taxable. I couldn't even tell you the number right now. It's over 180. I don't deal with it a ton.
Okay.
But if you're making more than $180,000 as a taxpayer, so if you're a married couple, it's not $180,000 both. It's one individual making more than that threshold. You then no longer get taxed on Social Security. So it's a large number, though. Once you get there, pay someone to walk you through the entire process. Medicare is still due. Yeah. Awesome.
Any question? Yes.
So you were saying something about the difference between a hobby and a business.
Mm-hmm.
So, I mean, obviously businesses get taxed, but if it's just a hobby, you're still making money.
So hobby tax laws have really changed over the past 10 years. In 2017, the Tax Cut and Jobs Act came out, and then the One Big Beautiful Bill Act just came out as well. They've changed the hobby situation for many people, sometimes to the extent that if you have a hobby and you make income from it, that income may actually be claimed as, maybe forcibly claimed as income, even if you didn't engage in profit. So let's say I sell bracelets and I make $100 worth of bracelets and it's my hobby. I spent $500 doing it. I know I'm not making money off of it, but I want to give it to my friend for $5. You may still have to claim that as income, but not be able to claim any of the expenses against it. So hobbies are kind of a very unique area right now that there's not a lot of compliance with it, and there's not a lot of understanding around it. But if you intend to be profitable, there's an intention to be profitable. So I say that very, very widely. Um, if you intend to be profitable and make money off of whatever you're doing, you have that business. Not all businesses make money. It's the intention to make money. There's a very large difference there versus a hobby. I had a lady that was making very unique tables at one point, and she would sell these tables for like $4,500 a piece. But it would cost her $20,000 to make a table. So she was selling them at a loss. There was no profit. She actually had to claim all of that income on her tax return and could not claim the expenses associated with it. So she wasn't happy with that reality, but that was how the law was written. I don't know if that helps you.
No. Well, I guess, so as a hobby, you would have to file for income tax?
Yeah. There, in theory, you need to file it on your individual tax return. It's not your own. If you don't have, so your 1040, your personal tax return, for you as an individual, everybody here theoretically files a 1040 if they have a filing obligation. Your individual tax return would also have all of the income associated with businesses, which are not a partnership, not an S Corp, not a C Corp. Okay? So there are separate tax filings for businesses that are partnerships, S Corps, and C Corps. If you start a business or you start a hobby, that income is going to be on your personal tax return and should be reported through your personal tax return. An LLC that is a single member that has no election would be considered a disregarded entity. That's Schedule C, which is a business. Schedule C and business are synonymous to me. They mean the exact same thing. A business is filed on a Schedule C on the 1040, and that business is going to be there. It's considered a disregarded entity. The IRS doesn't identify people that are LLCs that have a single member. They just say put it on your personal. So that's why it's a Schedule C. Keep in mind, I guess I should really say this. If you and your friend are going to do something in the process of creating profit, and you intend to create profit with you and your friend. Now, we intend to create profit. It is two people together. You have created a partnership. That's a very, very large deal for people. You really need to understand that you and other people going into business together has a lot of tax complications. If you want to do it easy, do it on your own. If you want to do it with you and your friend, please go talk to somebody. I found a person that had started a business with another individual, didn't file for 5 years, literally made no money, and owed $25,000 in fines and penalties, just because they started a business together that failed. So don't be in that situation. Go talk to somebody if you're going to partner up with somebody else. Those are very large issues. So thank you for the question, though. It's a good question.
Anyone else? Yes.
Oh, I have a question. What's the difference between a sole proprietor and an LLC?
So an LLC is not a tax structure. An LLC is a legal structure. LLCs can be taxed in many different ways. You can make an election to be taxed as so walking back. An LLC that has one partner is considered a single member LLC. A single member LLC is considered a disregarded entity. And if you space out those words, the IRS literally disregards the idea that it is a separate entity, and then you are taxed as a sole proprietorship. Does that all make sense? Okay. The LLC, if it has multi-members, so if it has more than one member, defaults to partnership. So if it has one person, it's going to be taxed as a sole proprietor. If it has more than one member, it's going to be taxed as a partnership. unless you make an election to be taxed in a different way. So, yeah, if you're ever making an election of taxation to be taxed as a different structure, I know that the IRS gives you guidance. Please go talk to somebody before you go outside of the defaults. Please. That is my one wish. So, you have the same question, or?
With the whole hobby, I would say, in my aspect of it, let's say if I were to like sell beats, like knowing I would want to make profit off of it, would I have to put that under my 1040?
Yep. Yeah. It's difficult and a very heavy compliance obligation to start your own business and doing your taxes and financials properly. So just very much keep that in mind. Is like, if you do intend to do something for profit or you're making money from an outside resource, you really need to understand and just, I mean, there's a lot of resources out there. I hate to say ChatGPT does a decent job. A lot of AI does a decent job in just giving you your general obligations. And then from those general obligations, if you have questions, go and talk to somebody. It's not that hard to go find somebody that will just sit with you for 15 minutes and say, hey, this is how we need to approach. So,
And with that team, I know you would need an LLC because sometimes people will post their beats or things like that, and it's easy for them to like just steal it and somebody else can claim it to be theirs. But
yeah.
where does like tax come into play with that?
As far as the stolen intellectual property, or what are you worried about in being stolen?
Just getting the right to it, basically.
So goes towards the legal side of the world. You're going to want to look at trademarks and you're going to want to look at patents. Those get very expensive very quick as well. But that is theoretically how you would protect yourself from your ideas being stolen. Awesome.
Any other question?
Yeah.
Oh, all right. So like, I want to do freelancing, but I also want to have like a job while I do freelancing.
Okay.
How would I like handle my taxes if I were to do freelancing in like a W-2 job?
So you can have multiple sources of income. I have a job. I have a business. I have another business. So I have multiple sources of income. Having a W-2 job, you'll receive that W-2 at the end of the year. That W-2 theoretically goes into your own bank account. I imagine your business, you would want to have a separate bank account so that you can track things separately. So all of your business income and all of your business expenses would go in and out of that business account. And that's how you would account or reconcile for those business activities. As a W-2 earner, that will go on line 1 of your 1040. As a business owner, that will go on Schedule C of your 1040. And those two schedules will go together. I believe that the Schedule C ends up on line 9, if I'm correct. I don't know. And then it adds up all of your income sources, and then you get taxed on your total amount of income. There's tax returns that are 900, 1,000 pages. There's tax returns that are 8. I know that the simpler you are, the shorter they typically are, but I just had to print out 500 pages for one guy. So, multiple sources of income is not bad. You just need to understand how you're taxed on each of them.
All right.
Yep.
That makes sense.
She has a question.
So once again, go to a professional to file your tax for you.
Yeah.
I have my mom. She does taxes. So I can
Good.
ask her.
Yeah. Yeah. Ask away. Please get opinions over and over again. Awesome.
Yes, question.
I wasn't sure at the beginning, but I have a basic question, or I would like you to explain me better. So, what is the difference between how you call an LLC
Mm-hmm.
and solo proprietorship?
So the
You know what I mean?
yes. So an LLC.
Give me 1 second.
Yeah.
Sole proprietorship. I asked that because I see most of the people, they have a small business,
Mm-hmm.
and then they say it's LLC. So
Yep.
what is is the difference? So can a small business can have a LLC?
So an LLC may be a small business. A sole proprietorship may be a small business. It's a legal distinction, not necessarily a tax distinction. If it's a single member LLC, it's going to be taxed the same as a sole proprietorship. If an election has been made to the LLC to be taxed differently, then it would then not be taxed as a sole proprietorship. It'd be towards the election. But it's more of a legal distinction rather than a tax distinction. Does that make sense? There's not a ton of difference directly with I have an LLC versus a sole proprietorship for tax purpose. For legal purpose, in which case you would need to go see a lawyer to really dig into the differences. There is a world that I do not understand, even though I've been doing it for 3 or 4 years, that I don't want to understand. It gets very complicated. But from a tax perspective, an LLC and a sole proprietorship theoretically are the same, so long as it's a single member LLC. Yeah. LLCs are not taxed. So LLCs are not directly taxed. They are taxed as a sole proprietor. If you have an LLC with no elections, it's a disregarded entity. So a single member LLC, no elections, it's a disregarded entity and will be filed on your individual tax return. If you just start a business without an LLC, it will also be taxed through the Schedule C of your personal tax return. It's you. So, yeah, it gets complicated. I wish it was easier to explain. People have made it very difficult for no good reason, but that is the general idea, is that if you have an LLC, you have a business. If you do something in the process of profit, you also have a business. And there are LLCs that are not businesses too. It's just a legal entity. Like a lot of people will put their personal home, as they have more assets, they'll just put their home in an LLC. They live in it. It's a legal structure. It's not a tax structure. Hopefully that helps someone in the future, because it's expensive to run an LLC. Like, it costs you $100 extra, and if you don't need the legal liability, you're not doing it for me. You're doing it for the legal side. So, yeah.
Question?
What's the difference of passive income? So I hear that a lot. Passive income, passive. What is passive income, and what are all the ways you can make passive income?
So I'm not going to answer what are all of the ways, because, yeah, so there is an idea with the multiple sources of income that we were kind of talking about earlier, with having multiple sources of income. The most common type of passive income is going to be things like rental properties, where you go and buy a property and you rent it. Passive income is income which you are not active in. So there's passive income, there's active income, there's investment income, there's portfolio income. There's a whole bunch of different types of incomes. They have different opportunities within each of them. Passive income is mostly from the rental community is where you hear, hey, go get passive income. And it's usually in the sense that they want passive losses. They want to claim losses on their tax return. The United States allows you to depreciate property. So you go and buy a property. You depreciate the property. It overcomes whatever cash flow income that you might have. The depreciation, it allows you to claim a loss on your tax return. If you claim a loss on your tax return, it doesn't get taxed, right? But the passive versus active argument comes in, because the goal of most people is to offset their active income with passive losses. And that doesn't really work. Passive losses can't offset active income unless there's certain criteria, and that criteria is extremely difficult to explain, and that is a 5-hour conversation and dependent on specific things. There are grouping elections. There are a lot of different things that you can approach. Passive income, you're typically not going to be active within. W-2 income is going to be active. You're working, you're creating that value. And the passive opportunities, typically you're not working within. Typically it's very, stocks is going to be investment income. So stocks can be passive. It gets into is it a corporation that you own that you're working within that is creating things like real estate interest, where that might then move towards passive. You would have to give me a specific situation to like literally explain passive, but typically we're going to be talking rentals whenever we talk passive, and stocks are typically going to be towards investments if they're held in your brokerage accounts.
What about a trust? Where would trust lie?
So trusts are going to be a separate legal entity, very similar to an LLC. They do have their own tax return. But in a trust, you can also have active, passive investment income. You can have grantor trust. You can have complex trust.
Okay.
It's, yeah, that gets very, very wide.
Lights, camera. Meet the pros who shape the industry and see what it takes to join them. Beyond the Frame, only at Orange Technical College East Campus.